Welcome back to the Daily Crypto Deep Dive. For most of crypto's existence, regulation has been treated as an enemy, something to be fought, delayed, routed around, or ignored entirely. The industry grew up in opposition to the traditional financial system, and for a long time that opposition was not just ideological, it was structural. Crypto existed precisely because it did not fit into existing rules. But what we are seeing now, particularly over the last week, is the clearest signal yet that this phase is ending. Not because crypto has lost, and not because regulators have suddenly become benevolent, but because the scale of the market, the volume of capital involved, and the number of institutions now exposed have reached a point where ambiguity is no longer tolerable for either side. This week's stories are not isolated headlines. They are connected pieces of a much larger transition, one that will define the next decade of crypto far more than price cycles or narratives about individual tokens. Let's start with the United States, because whether people like it or not, US policy still sets the tone for global capital markets. Over the past week, we've seen confirmation that multiple Senate committees are moving toward formal markups on crypto market structure legislation. That may sound dry, but it is arguably the most important development in crypto policy since Bitcoin ETFs were first approved. For years, the central problem in the US has not been whether crypto should be regulated, but who gets to regulate it. Is it a security, a commodity, a payment instrument, a new asset class entirely? That jurisdictional confusion allowed enforcement agencies to act first and define later, creating an environment where companies were punished without knowing what rules they were allegedly breaking. What the Senate is now attempting to do is draw boundaries, to define which assets fall under which regulator, how custody works, how exchanges must operate, and what consumer protections are required. This is not about banning crypto, it is about making it legible to the existing financial system. And that distinction matters enormously. Markets fear uncertainty more than they fear rules. A clearly regulated market can attract banks, asset managers, insurers, pension funds, and public companies. An ambiguous market repels them, no matter how attractive the upside appears. That is why the timing of this legislative movement matters. It is happening not at the peak of a speculative frenzy, but during a phase of institutional consolidation. The industry is quieter, more sober, and more focused on infrastructure than hype. At the same time, outside the US, regulators are moving faster. In the United Kingdom, this week saw the Financial Conduct Authority grant approval to Ripple's UK subsidiary. This was widely reported as an XRP approval, but that framing misses the real significance of the event. The FCA did not approve a token, it approved a company. And that distinction is crucial. The UK has been explicit about its goal to become a regulated hub for digital assets. Not a free-for-all, and not a hostile environment, but a place where crypto firms can operate openly under clear rules. FCA approval requires compliance with anti-money laundering standards, governance requirements, reporting obligations, and operational transparency. This is not a rubber stamp. It is an expensive, time-consuming process that only serious firms attempt. For Ripple, this approval does not magically resolve its US legal challenges, but it does something arguably more important. It anchors the company within a major global financial jurisdiction. It provides a base of legitimacy that banks and institutions can point to when evaluating partnerships. And more broadly, it sends a message to the market. Regulatory approval is possible, and it is happening now, not someday in the distant future. We see a similar dynamic playing out in Asia. South Korea, long known for its active retail crypto market and cautious regulatory stance, is now signaling a potential reversal on spot Bitcoin ETFs. If this materializes, it would represent a major shift in how crypto financial products are treated in one of the world's most important trading hubs. ETFs are not just investment vehicles. They are regulatory instruments. They bring crypto exposure into the realm of pension accounts, retirement funds, and mainstream brokerage platforms. They normalize it. When a country moves to allow spot ETFs, it is effectively saying that the asset has crossed a threshold of legitimacy, that it can be held, tracked, and traded within existing financial infrastructure. The convergence here is striking. The US is debating market structure. The UK is granting operational approval. South Korea is reconsidering ETF access. These are not random moves. They are different jurisdictions responding to the same underlying reality. Crypto is no longer ignorable. Institutional behavior reinforces this picture. This week, reports emerged that Tether has invested significant capital into a crypto lending platform at a substantial valuation. Again, this is not just about the size of the investment. It is about who is making it. Tether sits at the center of global crypto liquidity. Its stablecoin is used across exchanges, protocols, and markets worldwide. When Tether deploys capital strategically, it is not doing so lightly. Crypto lending was one of the sectors most damaged during the last downturn. Excess leverage, poor risk management, and opaque practices led to high-profile collapses. The fact that capital is now flowing back into this space suggests that surviving firms have been forced to mature. It also suggests that key players believe the regulatory environment is becoming stable enough to support long-term financial services again. This ties directly into commentary released this week by Andreessen Horowitz. Their view is that crypto's next phase will not be defined by new blockchains, but by applications, services, and integration with the real economy. That assessment aligns with what regulation enables. You cannot build scalable financial products on regulatory quicksand. Payments, lending, custody, identity, and compliance-heavy applications require clarity. They require rules. And paradoxically, they require the very institutions crypto once sought to bypass. This is where the narrative often becomes emotionally charged, but it shouldn't be. Crypto does not stop being crypto because it is regulated. It stops being fragile. The early phase of crypto rewarded speed, novelty, and risk tolerance. The next phase will reward durability, compliance, and execution. That does not mean innovation dies. It means innovation changes form. Instead of launching a new token every week, the industry begins to optimize settlement, custody, interoperability, and user experience. Instead of chasing speculative inflows, it begins to compete for institutional mandates. That shift is already visible in how markets react to news. This week's late session surge was not triggered by a meme or a viral rumor. It was triggered by policy signals, legal clarity, and macro developments. That is a different market than the one many participants grew up in. And it is one that behaves differently. Volatility does not disappear, but it becomes contextual. Moves are driven by timing, liquidity, and confirmation, rather than raw speculation. Markets react not just to what happens, but to what it implies about future constraints and freedoms. This is why regulatory clarity is not a bullish or bearish story in isolation. It is a structural story. In the short term, clarity can be uncomfortable. It forces projects to comply or exit. It exposes weak business models. It reduces the appeal of regulatory arbitrage. But in the long term, it expands the addressable market dramatically. Institutions do not allocate capital into systems they cannot explain to their boards, auditors, and regulators. What we are seeing now is the slow construction of that explanation. Crypto is being translated into a language traditional finance understands. The cost of that translation is loss of anonymity, loss of ambiguity, and loss of the romantic idea that crypto exists entirely outside the system. The benefit is access to orders of magnitude more capital. This is the trade-off the industry is now making, whether participants like it or not. And it is why the next bull cycle, when it comes, will not look like the last one. It will be less chaotic, less explosive, and less forgiving of nonsense. But it will also be deeper, broader, and more sustainable. The stories from this week and last week are early signals of that transition. Not headlines to chase, but markers to note. Crypto is not being killed by regulation. It is being absorbed. And once absorbed, it becomes very difficult to remove. That is the real story beneath the noise. Drop your thoughts in the comments, smash like, follow for the next deep dive, and we will see you at the top.